So clearly we've been discussing a lot of this information since the PPP and all the SBA loans came out about 90 to 120 days ago. A lot of the information that I'm going to be providing in this webinar is information that is layered above prior information and webinars that we had. So some of the stuff we will not be getting into too much detail. And if you want more detail, please feel free to reference our prior webinars that are on our YouTube page, and you can access those via our website. You go to on the website, there's a COVID-19 area that you can click on, and it'll take you to all the webinars that we've done, and you can kind of reference those in the past. So essentially, kind of as we move forward here, this is the update as of kind of extension of the number of weeks you can spend your PPP, and new rules and updated applications that have come along the way. So let's get rolling here. So kind of June updates, along the way here is that essentially Congress and the president basically passed a bill, I think about a week and a half ago or 2 weeks ago, on rules changing the PPP. The biggest frustration with the PPP for a lot of people was that I received money, I needed to spend it in 8 weeks on employees as well as operating expenses. But during those 8 weeks, a lot of my businesses, or a lot of our clients' businesses were closed or shut down, or they had to let employees go, etc. Retail stores, gyms, restaurants, etc. Right? Well, how do I spend the money? And now I can't. I don't have an opportunity to get that loan forgiven, where I have to actually pay it back. So essentially, those rules, which we're going to talk about today, the SBA, after those rules were passed, the SBA basically just recently updated their kind of loan forgiveness applications. We'll touch base on that. High level of what kind of the biggest thing that changed is that the period to spend the money or to spend the money received on applicable expenses extended from 8 weeks to 24 weeks, from 56 days to 168 days. So instead of having 2 months to spend, you basically have 6 months to spend all of those expenses and to try to get them forgiven as long as you can. Basically, additionally, the payroll requirement. So basically, you had to, the amount of loan forgiveness, you had to spend 75% of that on payroll-related expenses, salaries, wages, health insurance, contributions, benefits, etc. Well, they decreased that to 60%, which is great for a lot of people because, again, a lot of clients or a lot of businesses were closed or shut down or have minimized their employee fees or expenses, but the rent is still, in place, or their utilities are. So now that it goes from basically 8 weeks to 24 weeks, you can fulfill that bucket of forgiveness bucket more from those, kind of operating expenses that are non-payroll related. The safe harbor guidelines, deadlines, the ones related to kind of getting your salary or wage reduction back to normal, as well as your PPP reduction back to, or your full-time equivalent headcount back to normal. Before was by June 30th, you had to rehire or those folks. Now it is extended to December 31st. We'll discuss a little bit about that as well as we go forward. Owner compensation limits, owner compensation limits, much more restrictions on owner comp as that comes out. A big thing that they don't want to do clearly is have owners of businesses just take all the money out for themselves and then get it forgiven and not have to pay them back, because that's not the whole goal of the program. We're still unclear on the tax deduction of forgiven expenses. So again, the loan itself isn't taxable, right? But as of right now, the IRS is a separate body than the SBA, right? Well, as of now, the IRS is still saying that any of the expenses that are being forgiven aren't able to be deducted on your tax return next year. That doesn't mean that you're going to get specifically taxed on that. It all goes down to the bucket of your net income of your business, but it still seems to be that they won't be deducted as of now. That could change clearly because the IRS has 6 more months to make decisions for next year's taxes. The loan after June 3rd of this year, if you receive funding after that or loan after that, you're able to do the repayment period of 5 years versus 2 years, right? As well as you have up to 10 months of deferred payments versus 6 months of deferred payments before that. Interest still accrues on that. I'm not sure exactly how loans before that are going to be handled, but I wouldn't doubt if they just allow you to select or pay back those loans in 5 years and have 10 months of deferred payments. Again, that isn't clear. They have specifically stated, for those that are handled after June 3rd. In terms of interest accrues, basically what's going to happen, from my understanding, is By interest accruing, basically, interest will accrue on the balance that you do not get forgiven. So if you have a $100,000 loan, you get $80,000, $100,000 PPP, you get $80,000 forgiven. That 1% interest over those 10 months of deferred payments will accrue only on the $20,000, so the balance that kind of comes up along the way. So again, that's my understanding. We'll still see how that plays out over time. And as always, there still is no prepayment penalties or fees that comes up. So if you get it, and you can pay it off in 6 months if you want without any fees. All right, the new applications. Basically, biggest thing that they've done with the applications, the original application that we chatted through about a month, 3-4 weeks ago in our webinar, and that was released, basically is very similar to the old one. And outside of the updates for the new rules and timelines, adding in some new safe harbors, changing the 8 weeks to 24 weeks, changing, the safe harbor dates from June 30th to December 31st. The biggest thing that they've done is they've added an easy application. So the original application has Schedule A worksheet, et cetera, and it's kind of a little bit more very cumbersome to kind of walk through. Well, a lot of people won't even need to go through that because of the reasons I'll say below. So they have basically created an easy application. And what the easy application does, it has taken away some of the schedules and the calculations you need to do. So basically they're saying, if you have no employees, if you haven't reduced your headcount, and if you haven't reduced your salaries or wages, well, you can just use the easy application because it just has the basic information that you need to deal with. So if any of these 3 items are applicable, then you can do the easy application. Again, this is just after the fact when you're ready to actually apply for forgiveness. So number one, if you're a self-employed individual, independent contractor, sole proprietor with no employees, you can use the easy application. Why is that? Because you don't have any employees, you're by yourself. So you haven't reduced anybody's wages, you haven't reduced headcount, you're just dealing with yourself. The second bullet point is that borrower did not reduce wages by more than 25% during the covered period. The covered period is basically either the 8 or 24-week timeline after you receive funding in terms of when you can spend those expenses. So basically, if you haven't reduced wages by more than 25% versus Q1, and you did not reduce headcount from January 1st to covered period. So what does that mean? Basically this year, essentially it's saying that you didn't reduce headcount, you didn't reduce wages, and you received the PPP, good. Well, then you can use the easy application because you don't need to do those other calculations that exist. The third bullet point is if you haven't reduced wages by 25% again, and you're unable to operate the same level of business activity as of February 15th between March 1st and December due to compliance with orders, laws, and regulations passed due to COVID. So this is the biggest difference in this entire kind of safe harbor process is they finally, outside of the 24 weeks and the 60%, they finally have added a clause that says, look, if your business was basically directly and even indirectly impacted by the rules and regulations passed by OSHA, the CDC, federal government, state governments, local authorities, et cetera, to close your business or to not allow people to come in or to have restricted hours and things like that. If your business was impacted during that period from March 1st through December 31st, that's still December 31st. You still have 6 months to get your business back to normal. If those entire 9 months it still didn't get back to the levels where you were as of February 15th, you can check the box and you basically are able to kind of get past the rehiring headcount clause that they have or the safe harbor they have. So basically, if those 3 things apply to you, when you actually fill out the application, you can do the easy application, which basically will probably be like 30% less, or it's 30 to 40% probably total time, which is the original application, much less to deal with. And Elliot, I see your question on EIDL. I'll bring that up in when we touch base on EIDL. Updated guidelines here. So again, we've talked about that. So 8-week covered period extended to 24 weeks. So the covered period again is the date of the funding of the loan plus whatever the covered period dates are. So essentially, if you receive the loan prior to June 5th, you're still able to use the 8-week period. Well, why would somebody want to use the 8-week period? Because they've already spent the money, they've already, are getting 100% forgiveness, and they're ready just to get it over with, right? So, okay, great, go ahead and use the 8-week period. If you receive the loan after June 5th, you have to use 24 weeks. One thing is that I believe that the period itself, as of now, the last date that you can actually apply for a PPP, and I think they have $1 billion still left, for anybody that hasn't, is you can still apply for the PPP now, I think through June 30th. So like through next Wednesday, you can apply and still get that. At no point though can the covered period extend past December 31st. So if you apply just, June 30th, you get the money on July 5th. Well, 24 weeks from then is almost December 31st, right, of this year. So that covered period cannot extend into 2021 at this time, which I don't think it's going to affect a lot of people unless, another wave of PPP comes out for whatever reason. Again, at least 60% needs to be pay-related costs, down from 75. The EIDL advance will still reduce the forgiveness amount. That advance is the one that's up to $10,000. It's basically a grant. It's not taxable. And it was up to $10,000, essentially $1,000 for each employee. If you receive $5,000 on the EIDL advance and you have a $100,000 PPP loan and you spent it all and you're expecting full forgiveness, they're basically going to make you pay $5,000 back at that 1% loan for 5 years. That's essentially how they're going to do it, because they don't want you to double dip and get essentially free money at the EIDL advance and a PPP. The payroll costs for employees need to be people that are employed in the United States physically. They don't want you to have employees or people that you're paying outside the U.S. It needs to be in the U.S. And then the payroll cap on is still based on $100,000 annualized salary. That's always been the case. But now that it's 24 weeks, essentially for non-owners, so owners have a different thing that I'll get to in a second. For non-owners, for that 24-week period, the maximum you can pay somebody for that covered period is $46,153. So that's basically $100,000 divided by 52 weeks times by 24. Previously, it was the $15,385, and that was basically the 8-week equivalent of 100K. So again, that's for non-owners. That's the max. So basically, if you pay somebody for 24 weeks or whatever, then that's that 46,000. Even if it takes you, let's say it's going to take you 10 weeks to pay to hit your loan forgiveness amount, right? Or if you got a $100,000 loan, it takes you 10 weeks to get that $100,000 paid for, right? You could still basically pay somebody up to $46,153 during that time, because you're going to use that as your covered period. All right, new rules on owner's comp. If the 8-week covered period, the max of the owner's compensation is still $15,385. So that's the same, and that's what it was. But now for 24 weeks, they're saying that the max is only $20,833. So if you remember the last slide, non-owners can go up to $46K. Owners of companies can only get paid $20,833 during that 24 weeks. What is that? That is basically 2.5 months equivalent of $100,000. So $100,000 divided by 12 months times by 2.5. You remember this clause? This was still in place like last time when the original application came out. You're still unable to exceed the amount of comp paid in 2019 for the similar covered period used. So essentially, if you didn't get paid in 2019 as an owner, you can't get paid during this loan. Or if you got paid $10,000 last year during that equivalent time frame, you can only get paid $10,000. So they just don't want you to get nothing and really increase your wage base during this PPP as part of the loan forgiveness aspect. So that's a key aspect to look into. Health insurance paid by company for owners cannot be included unless, if you're an S corp, you use if you're an S corporation owner, and if your health insurance is properly included in your wage for S corp health insurance, then basically you're able to kind of use that portion as per a loan forgiveness. You cannot, if it's not included in that and the company is paying directly to Blue Cross Blue Shield United, you can't use that portion because that's just the rule. If you're a partnership, a 1065K1 partner, getting guaranteed payments, if you're a Schedule C, your basically health insurance paid by the company cannot be included in the calculation for the owner. If you're a C Corp owner, similar to S Corp, you should be able to get the company contribution portion. And then the same thing, retirement contributions paid by company cannot be included unless you're basically an S Corp and a C Corp. I should put C Corp in there too. You include the employer portion. But if you're a Schedule C or a 1065 partner, you can't include it just because of the way your tax return works. You'd basically be kind of double dipping as part of it. So Christina asked, what if one owner is making much less than 100K and the other is making 100K? Can we average the two if they're equal owners? They don't really care. No, they're going to go back. I guess if the question relates to if one person made much less last year, they're going to look at each person, owner one, and what was owner one's 2019 comp, owner two, and what was owner two's 2019 compensation. So they're not going to be able to average them. They just don't want you to double dip or to exceed it. So you're going to have to look at the individual comparison basis. I don't think you'll be able to average it. But in terms of reducing wages for owners, they don't care if you take zero wages versus the PPP. They won't penalize you as part of the loan forgiveness because they don't really care if the owner pays themselves. The goal with them is to basically have all employees get paid. All right, the safe harbor update. So the safe harbor, when you basically, if you reduced your team members' hourly wage and or salary by more than 25%, or if you reduce headcount, basically you can basically rehire people or get their wage back to normal or back to basically pre-COVID. It used to be June 30th, now it's December 31st. So you have much more time to get them back to kind of the normal salary base and the same headcount. The calculation is the same as prior. So basically all the calculations that we discussed in the last webinar is the same from the 8 weeks versus the 24 weeks, right? It's just a different time frame. The one thing that I'll say as part of this, and I'll get to the next thing, is basically what they're saying is they're comparing the initial February 15th, so pre-COVID, then they're saying, did you reduce headcount and or salary wages between February 15th and April 26th? If you did it during that time, then you can get back to the salary wage levels and the headcount by December 31st. But that doesn't mean right now you can lay somebody off now and then come back in December 31st and basically get credit for that if you haven't spent your forgiveness portion yet. So you have to be careful. If you reduce it during that February 15th to April 26th timeframe, then you can kind of factor in these safe harbor guidelines. If you didn't, then you have to kind of do the entire calculation and do an analysis on your end appropriately. The new safe harbor here is basically, you can read it there, I'm not gonna read it, but this is where it's saying that the legal portion where you couldn't get your business back to the same level of business as of February 15th of this year, so pre-COVID, based upon rules and regulations issued between March 1st and December 31st by the Health and Human Services, CDC, OSHA, etc. Those all look like federal agencies. They are. They did come out with an interim final rule that basically was like they're gonna be very loose with borrowers in terms of them saying, well, hey, I was impacted directly or indirectly, because it could be with state guidelines, with local city, town guidelines, etc., that closed you down. Additionally, I'm unsure if it'll have to be purely directly, right? We're saying I wasn't a direct client or a direct industry that was impacted. Whereas you could also make the situation or make the actual argument that, hey, I was, for example, a catering company that caters events. Well, all events got canceled because of these rules that existed. So then my business got impacted. So it's not a direct impact, but it's an indirect impact. So I would imagine that you could still check this box because you're just like, look, there was rules and guidelines that existed that impacted my business directly where I couldn't get back to the revenue levels where I was at. So the other reduction details, the Safe Harbor 2 now they're calling it. Again, this is what I just discussed. If you reduce your wages or headcount between February 15th to April 26th, from your 215 kind of headcount, you can rehire people by 12/31, and then your forgiveness kind of that deduction goes away, right? So again, it was June 30th. Now you have until 12/31. So if you think about that, when you have to apply forgiveness, right? Apply for forgiveness, you're going to have to wait until January of next year to actually apply for forgiveness, because then you have to confirm that as of December 31st that you rehired people. The same headcount, the same salary, wage reduction. And then that's similar to the second, aspect I have there. Again, with the salary wage reduction, they don't care if anybody that made from 2019, or they don't care about your employees. They made over 100K last year in 2019 and or owners. You could reduce them more than 25% and you won't get penalized, because they're saying, hey, they're already high wage earners. It doesn't matter. They have enough money to manage their life, or they can get reduced by more than 25%, they're fine. They're caring about the people that made less than 100K. Those are the ones that are going to impact your salary wage reduction calculation. Beth Spiegel, Safe Harbor 2 clarification. We had one person quit and one fired for cause. I'll get that in 1 second. Right here, Beth. Good timing on that. So reduction exemptions for headcount. So these do not reduce loan forgiveness. So again, if you remember, there's in the application, there's the loan forgiveness is, hey, I had 10 people, now I have 9. So basically you go 9 divided by 10, so 90%. So let's say that you had a $100,000 loan, you spent it all, but you reduce your headcount and you don't check any of these boxes, then you only get 90% forgiven. So the FTE equivalent portion is very impactful because even if you had 5 people, then you basically only have 4. Well, that's 80%. So it can get very quickly reduced based upon that headcount calculation. Whereas kind of the salary wage reduction actually is a bit easier to kind of manage because it's less of a direct impact. It's not a percentage calculation. So anyways, these ones essentially you can reduce headcount in these manners and not get penalized. Is basically what this slide is. So the first one is any positions for which the borrower made a good faith written offer to rehire somebody who was an employee as of February 15th, and then you let them go, let's say, or they were unemployed. You basically made a good faith offer to rehire them. They said no, or the borrower was unable to hire similarly qualified employees for unfilled positions on or before December 31st. So the 2 kind of things in this first clause. Number 1, you laid somebody off after February 15th, but they were employees of February 15th. You went to rehire them. They said no. Again, documentation is key here. The second thing is saying, I was trying to rehire somebody, but I couldn't find somebody similarly qualified. That's a very gray, loose situation, isn't it? Because you have until December 31st to hire a similarly qualified employee. Again, this goes to the owner of the company. You have to check the box saying, I couldn't find a similarly qualified employee. If you end up getting audited for whatever reason, you need to make sure you have documentation, search records, things like that show that, right? But again, this is kind of helps out, you in that factor. The second point, any positions which the borrower made good faith written offer to restoring reduction in hours at the same salary wages during the covered period, and the employee rejected the offer. So number bullet point 2 basically means that they were getting paid 40 hours, let's say. You reduced them to 20 hours for whatever reason during COVID. You said, all right, let's move back to 40. And they said, no, I want to stay at 20 or whatever it is, right? So that's, again, it goes back to documentation. But again, that's where that comes into play because they were 1 full-time equivalent. Now they're a half, 0.5 equivalent. So they reduce your headcount, but you get credit for that. And then the last point, any employees who were during the covered period who were fired for cause, voluntarily resigned, or voluntarily requested and received a reduction of their hours. So the last bullet point is if they're fired for cause, you still get credit for them. If they're voluntarily resigned or reduced hours, you get credit for them. So in summary, what this means, basically you're saying is if somebody quit, you tried to rehire them, they said no. And you couldn't find a similarly qualified individual to rehire as of 12/31. The second thing is hey, you had to reduce their hours for whatever reason because of the COVID impact. You told them, all right, let's go back and restore your hours. They said no. And the third thing is you fired them for cause, or they voluntarily resigned or voluntarily requested and received reduction of hours. So if any of those happened during the covered period versus February 15th, basically, or the reference period they call in the application, then you don't get penalized for that. The thing about this is it's only if the position wasn't filled by a new employee. So what this basically saying is like, they don't want you to double dip here, right? So for example, you fire somebody for cause and you rehire somebody for the same position, well, that's a net impact of nothing, right? You lost one, you gained one, so it's 0. So you don't need to worry about this fire for cause person because your FTE is the same, or your headcount is the same for that position. What they're saying is if you fired them for cause and you didn't rehire them, or that same position, right? Then basically, if you had 10 employees, you got rid of them, now you have 9. Well, you still got credit for that person because you fired them for cause during that aspect or during that period. So basically, those are the kind of the reduction exceptions where you won't get penalized as a business owner from a loan forgiveness standpoint. So urgent to-dos here, just again, kind of where we're at as part of the business. Again, this 24-week thing really helps out a lot of people. The 60%, of payroll versus 75 really helps out a lot of people, right? It really gets you to a point where like, okay, I can achieve maximum loan forgiveness here. But again, you do have to factor in the three biggest things you need to factor in are, did you reduce headcount? What is the possible impact of that? Do I need to rehire people? Do I have any safe harbors that I apply by or that I can abide by? As well as when do I need to rehire somebody or, rehire by December 31st, and how does that happen? The second thing is, did you reduce any wages or salaries by more than 25%? If so, how do I get them back up to the normal by December 31st to achieve maximum forgiveness? And then the last thing is, just as if you're an owner, S Corp, Schedule C, sole proprietor, partner in an LLC or partnership, understanding what your 2019 8 or 24 week equivalent salary or payroll is, and you can't exceed that, right? From the amount you get paid during the period. You can get paid more than that, but you can only basically achieve forgiveness up to that specific amount that you got paid in 2019. So just be cautious of those three things. Just make sure you're planning appropriately for this. I think the biggest thing really for our clients is going to be the headcount reduction and then the employees greater than 25%. Because that's kind of an analysis you have to do sometimes to say, okay, how am I going to get the headcount back up to where it is? What is my reference period? What was my headcount as of this date? How do I get the average headcount back up as of the covered period? And if you're not at all close to the maximum loan forgiveness amount, how do I get back up to hire and pay employees? And at the end of the day, remember, the balance is a 1% loan paid over 5 years, basically, right? So it's not a huge debt burden, which helps out from a cash flow perspective. The last thing I'll say is just kind of an example here. And this is an interim final rule that I sent out, I think, 2 days ago. Let's say that you got the loan on April 1st or whatever, and during the 8-week period, you did not spend all the money, but you did by week 10, right? And then you abide by everything else. Let's say that by week 10, you had spent all the kind of money on payroll. Payroll was at least 60%. You kept your head count the same. You didn't reduce any wages, right? So you apply everything you're doing great on. You can basically apply for forgiveness at that point. Again, application goes through the bank. So you need to communicate to your bank on that. But you can technically apply for forgiveness at that point. This kind of goes to Jody's question originally, and let your employees go at week 11, right? So at week 10, you spend it, you can apply for forgiveness, and then you can let employees go or reduce their wages after the fact and not get penalized for that. That's a huge kind of gray area that I had as I was reviewing this. I was like, wait, a lot of my clients are going to spend all this by week 16. And then all of a sudden, what are they supposed to do? Just wait for the end of the 24-week covered period? Because then they have to wait for that, and then they have to assess headcount there. Well, that doesn't make any sense, because they went ahead and kept their employees paid through the 8 or 10 or 16 weeks. And they kept them paid, they kept them hired, they kept their doors open. So that's a big situation that came out earlier this week. And the thing about banks, talking with a couple of bankers, they have stated that some of them aren't even accepting forgiveness applications yet, because they're expecting this stuff to keep changing, and they just don't want to, because they jumped so quickly when the PPP was being processed, and then there was 75 changes that they're like, you know what, this is getting more streamlined, there's some new rules coming out, but until we kind of get some finalization of gray areas, will we start kind of finalizing or processing forgiveness applications. So again, the forgiveness is going through the bank that you received the money from, so continue to work with them on that aspect. So that's basically everything from a PPP standpoint. Just kind of one slide on the EIDL. EIDL, probably the last month, a lot of my clients have actually received money. Get an email, hey, you've been approved, and gone through this. The loan process is much more streamlined. It was up to $150,000 of the loan. Unless you got it really early, you could have got above that. I don't know how they calculated total amount. A lot of my clients got 150, some got 105, some got 90. I don't know how they calculated that. That loan is a 30-year term at 3.75% interest. If you're a nonprofit, I believe it's 2.75% interest, and with a 12-month payment deferral, right? So you basically don't have to pay anything. Interest does accrue on that loan, but it's just like a mortgage, right? It's like $500 a month. It's a very cash-friendly opportunity for businesses to kind of take a breather for 12 months, kind of continue to support operations and go from there. The last kind of 3 or 4 weeks, they had closed it The new applications only for to agriculture businesses, but they did reopen it back to normal businesses, all businesses of like last week. Again, you have to abide by the disaster loan rules and things that kind of come up along the way. If the loan is over 25K, there is collateral. I don't know, it's like a 10, 15 page application form that, or not application, loan document form that you guys all filled out. I've got a handful for my clients. The one thing, a couple things that come up, and if there's any specific questions on how to use the EIDL funds, let me know. But number one, the proceeds, it says they're, before they sent this document out to sign, they did say that there was a lot more requirements up front, like before people receive these loan docs. Anyways, now it basically says there are some restrictions. Number one, proceeds to be solely used as working capital to alleviate economic injury caused by COVID. What does that mean? Basically, what it means is that, from my perspective, working capital essentially is outflows that are due the next 12 months. So normal operating expenses, right? Payroll, accounts payable, short-term debt, debt service, right? Credit card payments, short-term loans, etc., right? Paying inventory to resell, kind of the traditional stuff that you work on a day-to-day basis. From a short-term aspect, that to me, that also means like paying off high interest debt, like line of credits or credit cards that are due, right? Line of credits and credit cards are due every month. A lot of us just pay minimums or just pay interest. But if that's due and it's high interest, I would say that that's still a working capital need if you can consolidate it and reduce your monthly cash outflow because it's gone. So a client that has a cabbage loan or line of credit that has to pay $1,000 interest plus $4,000, $5,000 a month in principal to keep that line of credit going, well, pay that off, and then you save that $1,000 a month interest, right? So you have to look at it from a working capital cash management, short-term cash management, up to 12-month standpoint. I would not be paying bonuses as of this. I would not be buying equipment as of this, although there's a clause that says if you buy equipment, it needs to be U.S. made. Like by equipment, I mean like fixed assets, capital assets. I wouldn't be buying another company. I wouldn't be using it in that aspect. I would use it for working capital to sustain the operations of your business. If you got the PPP and the EIDL, the goal of it is the PPP to keep your doors open for the next 8 to 24 weeks, right? Pay your employees, keep your rent open, and then the EIDL is more of a long-term situation to support the operations of your business long-term. You can use it for payroll after PPP, but you can use it, if you got them together, you can use it to pay 1099 contractors during the PPP because you can't include 1099 contractors in your payments. You can use it to buy inventory because that doesn't, fall underneath the PPP loan. So just being smart about this. Essentially, I don't know how they're going to audit this if they are. At the end of the day, it is a loan, right? So that means that the loan itself needs to be paid back. PPP is going to be much more, I think, examined because you're actually getting a loan forgiven, right? You're getting free money, right? Versus this year, you have to pay it back. The loan terms are great. There's no upfront fees, but at the end of the day, like you still have to pay it back. So I doubt there's going to be as much, supervision over this in terms of where the proceeds are go, but you need to be smart about it. Just think about doing a tax return. If your personal tax return, your business tax return, you're signing up at the bottom of it. You're saying everything in here is legit and accurate, right? Well, you could get audited in 4 years. You just, who knows, right? You can get audited in 3 years. Well, then you get to, prove what's in it. So if this happens, you need to show them where the $150,000 was spent. You don't need to spend it in the next 12 months. You can spend it, afterwards. There's no requirements for that. So you just have to be conscious of that. It does say within there also that there is, requirements around it needs to be audit friendly. It needs to be, very like reviewed and things like that. I wouldn't be worried about that. Again, like they're not going to require those types of things of, hey, were your books audited? Can you sign off on these? Like it goes back to maintaining proper books and records, right? Being smart about your business, documenting what you need to do. Hey, this $150,000 loan, this is where I spent it, right? And you don't need to get a separate bank account. It's just about maintaining your QuickBooks file, updating and reconciling it, and you can earmark things that says this is where the $150K went, right? And making sure, again, it's short-term. AP, inventory, short-term debt, payroll, 1099 contractors, etc. So basically, that's kind of a big part of EIDL. Again, in one big clause, it says it's unable to be used to relocate a business unless you were impacted. Your location was impacted due to COVID, right? So again, realize that. And then I'm reading a question from Elliot here. Okay, and then Elliot asked about they received an amount that was less than 150,000. They didn't understand how the money actually that was calculated. Can he apply again for an additional EIDL or take a wait and see approach until the second tranche of EIDL becomes available? Elliot, if I was you, I don't think you can apply for the EIDL again. Similarly, where you can apply for the PPP again, because it's through the SBA. There's a loan processor. I would actually probably reach out to them and see if you can increase the loan on that. Just that would be my step one, to say, hey, can I increase the loan? They have to have somebody. Clearly, there's a lot of people working behind the scenes on that. But I would just work with them directly on that, because if you go through and do another EIDL application, you're going to put your EIN in there, you're going to get canceled. They're not going to like process it. So I would work with that SBA loan processor, or whoever your contact is along the way. Again, you may not get properly contacted right away because of the volume, but I think that's step one. And then clearly, because of what's going on now with COVID and the cases now going on and people freaking out now, and cities and governments providing more regulations, hopefully we get past this and hopefully we can get over this from an economic standpoint, but who knows what's going to happen long term. But yes, there could be a second tranche of PPP. There could be another one of the EIDL. We have no idea. I'm just giving you information today. Every time I have a conversation with you this webinar, it's up-to-date information. I may have another one in a month of new laws that were passed or new regulations that were passed. We really don't know. Just keep updated on the information. Keep tabs your advise with your accountant or advisor or your colleague or whoever it is to help you along the way. But that's basically all I have. And Accountfully is always here to help everybody out. This will be recorded and sent out as normal to everybody. And then we'll go from there. One last question just came up. And please throw any more questions in here. Could you please provide a rent list of items that the EIDL loan could be used for? Rent list, I would just say, again, short-term cash management needs. So just think again, when you run your business, what are the things I have to pay each month, right? Payroll, rent, utilities, 1099 contractors, inventory to sell, dues and subscriptions to Zoom, Gmail, short-term cash management. Again, anything that you, in the normal course of business for 12 months that you buy. Don't do anything crazy like buying, a machine for 35 grand, that you're going to use as a long-term fixed asset. Don't go ahead and give an owner of the company bonuses, etc. Right? So just think of it short-term, just normal course of business. What do you do on a month-over-month basis to do it? Again, if you got both the PPP and EIDL, the EIDL cannot be used for PPP-related expenses that were forgiven, payroll, rent, utilities, until the PPP period of spending is done. So just be conscious about that. But you can still use the EIDL during that time to buy inventory, to pay 1099 contractors, to refinance short-term debt, etc. So just be conscious about that. Another question. Can EQ, like a camera EQ, be purchased? I don't know how much that costs. If again, it's for working capital, which is short-term cash. If this is something that's going to be used for your business over the next year, I would hesitate that you'd use those funds for that, right? You have 150K if you got, if you're having those types of purchases you're thinking about, don't use the 150K on that. Use the 150K on short-term stuff, and the other money that you have in your business, buy the camera, right? Again, it goes back to books and records of what did I use the $150,000 for, and was I smart about it? I don't know specifically the cost of that, but just be conscious about that and ask your kind of advisors. And again, it goes back to the overall facts and circumstances of each individual situation. Similar to taxes, a lot of it's gray. Just be smart and be conservative about kind of your approach, because the last thing you want to do is essentially have something that happened and then also have to go back and get penalized or get extra fees because you weren't properly smart or proactive about it. So, all right, that'll be the webinars today. I appreciate everybody showing up. And again, we're here at Accountfully to help answer any questions specifically. Feel free to send me an email or Brad at Accountfully with any specific questions that come along the way, and hopefully answer all the questions that you had today. We'll be posting this on our website and blowing out on social media and our YouTube channel for reference in the future. Thanks.